Hi, I'm Nimant Matthew, Head of Research at First Capital. We have released a report, Equity Strategy, on last Friday, and our expectation is that the equity exposure should be reduced at this moment of time. So I will go into the report. And here we are expecting investors to reduce equity exposure to 65%. This is mainly because the ASPI has surpassed our fair value. So going into our recommendation, what we recommended, in June, we've upgraded our ASPI target from 7,500 to 8,000 levels from the previous 7,000 to 7,500 level. And we also expected basically for the market returns to be strong during the second half of 2021. Despite the economic uncertainty that is likely to be there, and we expected a market return of around 18% overall. And looking at the equity allocation, we expected beyond the 8,000 for the investors to start exiting their portfolios, reducing exposure. So looking at the current situation, you can see that the market expectations or market valuations have significantly increased for the second time this year. First time we saw it happen in January, and now again we are seeing the market PER exceeding 14 times, which we believe is a stretched level. And you can see that in this PE chart that the index has exceeded the fair value level that we targeted. And from here on, what we are recommending is to reduce equity exposure to 65% and to increase cash allocation to 35% from the 10% that we expected in January. So in January, we recommended a structure of 90% to 10%, 90% equity, 10% cash. And now we are changing that to 65% equity and 35% cash. And here investors can look at this recommendation in a couple of ways. Basically, what has happened is your actions actually will have to depend on the risk appetite of each equity investor. So one option for the investor is 7,500 to 7,700 range. There was a significant increase in the index due to some liquid counters. However, accounting for that 200 points, rather than 8,000, you could start exiting from 8,200 and upwards, and in different intervals start reducing your equity allocation and bring it down to 65%. But afterwards, if we see a continuous upward trend, we should further reduce equity exposure and increase cash in the market, expecting some sort of correction. The second option for investor is if that investor is basically has equity portion and wants to stay 100% in equity out of the equity allocated funds that he has, then the second option available is he can go into more defensive and high dividend yielding counters. Here you can look at counters or sectors that are at depressed levels, like the banking sector trading at less than 50% of price to book value, and or you can even look at very popular shares these days like the dollar income companies with the expected weak currency. So TJL, Haley's, Expo, Haycarb, Windforce, LVL Energy Fund are some of the shares falling into that segment, while higher dividend yielding companies are also preferred, where food and beverage and tobacco sector and the material sector are the ones mostly falling into this category. CTC, Nestle, Chevron Lubricants to are some of the examples. In addition to that, life insurance companies are also highly recommended, mainly because it has a significant benefit when there is a upward trending interest rates. So that is what we would like to recommend our investors, and we would also like to explain to you that successful investments is about managing risk and not avoiding it. So thank you very much. We hope you follow our advice going forward. Thank you.